Let's get more about this Powell problem and the impact on the markets, much more on this market reversal, and bring in our next guest, Adam Parker of Trivariate Capital. He's the CEO there. Adam, great to have you with us.
Good to see you. How are you?
Good. And of course, our viewers will recognize you as the former chief U.S. equity strategist over at Morgan Stanley. So congrats on your new gig. What's your take on what's gone on in the market so far, and in particular, what we've seen today?
Yeah, I mean, I think you guys are touching on some of the issues. You know, it's about the path for interest rates and the Fed, and it's about the virus. I remain pretty optimistic about U.S. equities if people have any longer-term perspective, because I think corporate earnings will be higher next year, and I think ultimately that's what matters. I was hearing you talk about some of the tech companies. As a small business owner, I think to myself, all right, well, I pay Microsoft Azure to do my compute and storage. I pay them no matter what happens. I pay Salesforce to communicate with my customers. I pay them no matter what happens. I pay United Health no matter what happens. You know, so there's a lot of businesses where I don't think their earnings are going to get hurt by Omicron now and Pi next June and whatever happens after that. And businesses can be resilient and have pricing power independent of a couple of day movements in the equity market.
Okay, so what fascinated me, Adam, about your view is that the Fed is not going to be in this market. It's not going to be hiking for years at this point, and that's not what they seem to be telegraphing. So why do you think 2024, 2025 could be the first rate hike?
What I know for sure is that nobody knows. Okay, I worked for years at firms where everyone tried to call the Fed, hockey rinks full of people at every major firm, and what you learned is they don't know anything. Okay, so I would just start with the premise that, all the experts on you have all the time, they're usually wrong and don't know because it's unknowable. Here's what I think we do know. The Fed are smart. They have access to great information. They can look at what's in the market. What's priced in is a 5-year break even for a long time, low to mid twos. So, maybe that's what people think the interest rates will look like 5 years from now. I think the Fed's focused on their dual mandate, right? Stable pricing, full employment. What have we seen? We've seen lumber down 50% in 6 weeks. We know that a lot of commodities are going to roll over. We know that the labor participation is weak and wages are going to be a question mark. So in the face of that, is the Fed going to move the front end a ton? I don't think so, or at least I think they're going to wait and see what happens in the middle of next year before they start doing it. So I don't think tapering and expanding the balance sheet at a less rapid rate is really the same thing as raising the front end a ton. We have inflation, we all feel it, but personally and professionally. But I think you try to figure out where is the market pricing inflation more than others. There's plenty of investment opportunities related to that. And I don't necessarily think it makes the whole equity market go way lower over a sustained period.
Adam, it's Karen. Thanks for being on.
Okay.
Just pushing back a little bit on this inflation, we're at 6%, and I understand maybe some part of it goes down a little, but we are so far outside of the 2%-ish, doesn't need to be exactly symmetrical, that I don't think the Fed has room to ignore inflation, so they have to raise. How do you get comfortable with there being inflation and no raising from the Fed until 23 or 4?
I guess it just depends on what you think is structural versus cyclical. If you're thinking about what really changed that could cause inflation to be different, you probably have some deglobalization, right? Semiconductor companies that used to do all their packaging and testing in Asia are now going to do it in the U.S. You have some of that trend. And I think one thing you said I kind of would peg at, Karen, is do you really think all the stimulus is over on the fiscal side? Or maybe you just meant monetary. But to me, you probably have some rolling fiscal stimulus no matter what's going on, cyber, alternative energy, and other areas. It won't be helicopter money like it was last year. So maybe those are the two inflationary forces that are different mark to market versus, say, 2019. But I still think you're looking at a long-term growth rate for the economy that's around 2. I think you're going to see some cyclical downturns, in areas that were hot. Lumber is probably the most recent example, but there's a lot of other areas like that. So I think the question is, when you get the commodity rollover and cyclical rollover next year in a lot of areas, and when you see the consumer starting to maybe, find it a little harder to pay gas at the pump, when you see them, they have record low delinquencies on their credit cards, you start seeing some of that raise a little bit. We'll see if the Fed feels like they should wait for more normalization. I don't know, but I sort of feel like whenever everyone thinks something's going to happen, they'll always end up being wrong.
Well, if you are right when it comes to your forecast for oil, Adam, the Fed might feel more of a need to move. I mean, you're seeing 150 to $200 a barrel in the next 12 to 18 months. Can the economy support that? I mean, you're just talking about the consumer. The consumer's paying 50% more on their gas bill than they were a year ago. And so if we go to 150 or 200, that obviously going to be a lot more pain.
Yeah, look, I hope, I try to keep it simple. I look at this year, what we've done at Trivariate Research, right? We're bullish on U.S. equities, and our number one pick's been energy. And so, yeah, there's weeks and days and hours and intraday reversals where those two calls didn't look good. But just plot, the market and plot energy. Like, energy is the best performing sector, and the market's up a lot. Like, I think if you have any horizon, that'll still be the case going forward. For me, I just look at energy and I think to myself, wow, I have this like triple crown of awesomeness, right? I have high price momentum, cheap valuation versus history, upward revisions, sentiment's awful. Everyone thinks the terminal value of oil is zero and I can't own it for ESG reasons. And if I look at what's priced in, probably oil $20-30 below where it trades now. And if I look at the risk reward, it's probably that oil has a better chance of being $50 higher than it does $20-30 lower. So I like the stocks and I'll own them, and I'll own the cheap ones with upward revisions for the next 6-12 months. I mean, I think that's, my mentality if I look forward. But sure, when there's a risk off trade, oil goes lower, the 30-year goes lower. I mean, we know what happens in a short horizon when there's a risk off trade. But I kind of agree with the sentiment of adding to markets when you get an indiscriminate sell-off. And look, I think what your average investor doesn't totally understand is there's lots and lots of money that are run in pods where the analyst's job is to generate a net market zero, 4% alpha per year, and it's run at like 1,000 gross. So when people get nervous, you get just a degrossing that happens, and that causes an exacerbated sell-off at times like this. And so you see that. And then when it reverses, the money piles back in. So I don't necessarily want to panic on a short-term sell-off personally.
All right. Adam, great to get your thoughts. Thank you.
Yeah, always good to see you guys. Take care.
Adam Parker of Trivariate. Guy Adami, what do you make of his trades?
I love Adam Parker. I mean,
I know you do.
I love his work. What do I make of the trade? It's interesting. What I would say is, if he thinks oil is going higher, by the way, I did as well. I thought we'd see triple-digit oil by the end of the year. It doesn't look likely, but if he thinks oil is going to move to that magnitude, I would submit by definition the Fed's going to have to do something, because the one thing I think the administration is looking at are energy prices. But that's another story. I do like oil. I'm surprised that OIH got as low as it has gotten. I guess it makes sense given this meaningful sell-off we've seen in the underlying commodity. But I think oil is still a place you want to be, albeit very painful over the last 2.5 weeks.